We expect S&P earnings growth to slow from 25% growth in 2018 to 5% growth in 2019. And the reason for the slowdown is, one, going back toward more normal earnings growth rates for the S&P, 5 to 7%. But also we think earnings growth is going to be challenged by the tariffs, stronger dollar, and curbed oil prices, because we don't think oil prices, WTI spends much time above 70 on average in 2019.
Okay, I just want to do a point of information on that. That 5, okay, is equal to and even a little bit higher than overall growth of the U.S. economy.
Of course.
So companies maintain their profit share and they even grow it a little bit.
Nominal.
If you do 5.
That's
nominal. That's what you do when you look at
yeah. And that's right. And you would expect that just because of the retention of earnings that companies put back into.
So that's good 5.
Exactly. I actually believe that 5% is adequate. It'd be a little concerning if we drop below that. But 5% earnings growth in 2019 should still support a nearly 18 trailing PE as long as the 10-year Treasury doesn't exceed 3.5%.
Howard, do you get in on the macro view from this perspective, or are you looking more bottoms up? How much of the
we
macro
do both. We do both. We actually think that sort of applying some business cycle analysis to the portfolio is helpful in how you build out your sectors and holdings.
So where do you come down on that?
We'd still be more in the 10% camp for earnings growth next year. You know, above 20% this year. A lot of that due to the tax cut, but we're still going to have fiscal stimulus next year, boosting government spending. CapEx spending is now beginning to do very well. Look at the payroll numbers as well. The economy is fundamentally very sound. And so what we're seeing in the stock market right now, we're sort of pricing in a slowdown, which is to be expected because we do have the higher rates, the higher oil. These things that tend to hit the economy with a lag.
Slowdown, a slowdown in the rate of growth, not a
slowdown in the rate of growth. Right. So we still have an economy that's growing really around 3%. So let's not be too picky. What we're seeing right now is very similar to what we saw late January, early February, a correction in the stock market of around 10%. The NASDAQ
Which we're not there yet.
Well, the NASDAQ hit it. S&P got down to 8. Yeah. So we're close enough. And so it's, unfortunately, in today's world, stock market corrections are fast, they're violent, they're frightening.
And you miss it?
The good news is they're relatively short. And I think this is an opportunity for investors who've been waiting to put money to work. This is it, because frankly, while the Fed is tightening, the Fed doesn't control long rates, and long rates have been stuck in the 285, 315 area for months now. I don't think they're going much higher. And if that's the case, then stocks should definitely be bought here.
If you think the market right now is truly kind of curled up and bracing for a steep slowdown, and next year's all going to be about, can the Fed engineer a soft landing, right? We've heard that in previous cycles. Then you have to see a huge tier of the market being underpriced, right? In terms of domestic cyclicals, things like that. Would that be where you'd be looking?
Well, not so much on the cyclical side. And the reason is we are seeing slower growth. We are pricing in slower growth. We're going from peak growth was second quarter of this year, 4.2 GDP. Now we're more around 3%. Next year, maybe in the high 2s. So in a slowing growth environment, I want to stay with my growth stocks, which is what I love. So I'm biased.
These have also come in.
And they've come down. So you've got an opportunity to buy some of these names that are down 15, 20%.
Let's talk about the ones you like. Amazon, Netflix, Google, Microsoft, PayPal, NVIDIA. I mean, you're very much in that technology group that's been leading the way.
I think you have to be. These are really the leaders in what I might call the new economy. New economy, consumer technology stocks. And how many people have been waiting for an opportunity to buy Netflix? Okay? Folks, belly up to the bar. This is your opportunity. The stock's down 20%.
You actually pounded the table.
They reported a terrific quarter last week and raised guidance. This is it, folks. The operating leverage is starting to build there. You're going to have explosive earnings growth over the next 5 to 10 years. This is it.
A bargain at twice a year ago.
140 million subs. Comcast, we love Comcast, 23 million subs. 140 on its way to 350 million. Folks, this is what it's all about.
David, how much does your view of the effects of the tax cuts color your investment outlook? And by that, I mean there's two stories out there. There's the story from Kevin Hassett and I think the believers in the tax cut, which is that the tax cut engineer a change to the DNA of the economy, and that they end up ultimately changing potential growth. So the number that we slow down to from peak growth of 4.2 is a higher number. Whereas the Fed and most economists, a lot of economists I talk to on the street, don't see it that way. They see us slowing back down to that 2% growth. And I think the important thing to note here is that one top-down way of looking at stocks is just how big is the pie? How much is the pie growing, and what's the share of company? So
to answer that question,
what's your take on that?
Two things. The easiest thing to describe is that the 25% earnings growth in 2018 that we expect for the S&P, a third is from the tax cut. And then when we just think about what the tax cut has done to the DNA of the economy,
right.
I believe it has raised the longer-term growth rate from what it otherwise would have been.
That's the wrong answer for Steve.
No, it's not, Joe. It's absolutely not. Because the right question is, the next follow-up is how much?
Probably a half a point, maybe 1 full point.
So 1.7, we were 1.8 was the potential. You think we could be at 2.5 underlying growth?
We think potential is 1.8 to 2.
And as I've said many times, Joe, if the tax cut ends up doing that in a way that the debt created by it is not hurtful to the economy, that's a huge win. It's a huge win.
I'm glad that makes you feel a lot better.
To connect these two themes,
Steve.
like we think growth will continue at a slower pace, but still a healthy pace, and the DNA of the economy's changed and investment spending is occurring, particularly on intangible assets, R&D. That's why we like growth stocks, and we like growth stocks out of emerging markets.
You like the same stocks that Howard is literally pounding the table on?
We like those stocks, and we like similar stocks out of Asia.
So even though you're a 5% guy, you're a 10% guy, you both think it doesn't matter.
The direction is what's
where you want
important.
to be. Yeah.
The direction is what is important. And going back to that concerns about the economy and the tax cut, the capital spending thing is big. Cap spending now is growing at 8%. So this is what's going to drive increased productivity. And as you know, we have to have the greater productivity to get that growth rate of GDP up and sustain it. It's the only way to do it because the labor force is what it is. It's growing at 0.8%. So you got to get the productivity up. And this is it's going to take a while, but it's happening, and it's happening, I think, faster than anybody would have expected 6 months ago.